Hi, I'm Pam Kruger.
And I'm Jack Gallagher from MoneyTrack.
MoneyTrack is a fresh, new public television series that gives consumers the tools they need to become wise and safe investors.
Hi, Pam and Jack. I would really like to start investing in a more serious way, but I don't have a lot of money to get going. What's a good strategy that doesn't take big money to get started?
Katie, do you have a 401k plan where you can contribute a little from every paycheck?
I don't have the 401k, and that's the reason why I'm trying to save up so I have enough to invest.
You know, Katie, the truth is one of the smartest investing strategies works just as well for people who have lots of money as it does for people who don't.
This is based on something we actually know, which is that historically, money grows faster over long periods of time invested in high-quality stocks than anywhere else, including real estate.
That's right. And the goal, Katie, is to buy a stock or a mutual fund at a low price and then much later sell it at a much higher price and capture a nice profit over the years. Now, to do that, the strategy that we're introducing to you today is known as dollar cost averaging, which sounds a little heady, but it's actually more like grammar school math.
Janet Bodnar from Kiplinger Personal Finance is here to walk you through how and why it works. This is Investing 101, folks.
Hey, Janet, thanks for joining us here.
Hi, Pam and Jack. Actually, I'm glad you're talking about this subject today because in the November issue of Kiplinger's, we actually chose dollar cost averaging as the best investment strategy there is. All you have to do is begin an investment account either with a brokerage firm or with a mutual fund company and invest a regular amount every single month. It can be very often as little as $50 a month. You don't really need a lot of money to do this.
Now, is that comfortable for you, Katie? Can you do that?
Yeah, I can do $50.
Katie, the next step for you is to do a little research and decide where you would like to invest that money, right, Janet?
If she decides, for example, to invest in a stock mutual fund, get in touch with the mutual fund company via 800 number. Tell the company that she wants to do that she wants to invest on a regular basis. And what they will do is they'll literally set up an automatic debit from her checking accounts. When you're investing your $50 a month or $100 a month, you are always investing that money, putting that money into the market or into the mutual fund that you're buying. And when the shares of the stock that you're buying or the fund that you're buying fall in price, you're actually buying more of those shares. When the funds or when the fund shares rise in price, you're buying fewer of those shares. But over time, the number of shares that you purchase kind of averages out, hence the name dollar cost averaging. It's just as if Katie were creating her own little 401k plan, her own little private retirement account.
And Janet, the reason why dollar cost averaging works so well is it actually removes the emotional part, those urges that make us want to mess up when we get involved with the stock market.
It takes away some of the psychological pain of investing because very often what happens is when the price of an investment goes down, we get afraid of it and we don't want to buy it. And that's when we should really buy more of it. The same thing when the price of an investment goes up and gets very expensive, we tend to buy more of it. And that's when we should try to buy less of it in order to, even out our price. So by imposing this discipline of dollar cost averaging and always investing the same amount of money, you are kind of protecting yourself from your own worst instincts and always investing evenly over time and buying the maximum number of shares that you can at the best price.
And again, the small amount over a long period of time actually pays off more than plunking down a big chunk all at once.
You know, Jack, you're absolutely right about that. And again, it's a matter of investor psychology because sometimes when you come into the market with a lot of money to invest, your tendency is to try to put it into the winners, the funds or the investments that are going strong now. And what happens is you overinvest at the top of the market at just the wrong time. On the other hand, if the market is down, your inclination is to keep your money in the bank and not put any money into the market when that's exactly when you should be buying. So this way, once again, dollar cost averaging saves you from yourself. If you're investing consistently over time, you're not trying to time the market, and chances are that you're going to have a bigger nest egg when it's all over and when you're ready to retire.
The MoneyTrack series is not sponsored by the financial services industry.
Nope. We are funded entirely by a grant from the nonprofit Investor Protection Trust. To find out when and where you can watch MoneyTrack, go to moneytrack.org.
And remember, always investigate before you invest.